Michael Lewis. He's Global Head of Commodities Research at Deutsche Bank. Michael, thank you so much for coming in. Now, since we last spoke, which was about a month and a half ago, has anything changed in terms of your perspective of us falling into a recession? Because that, of course, I guess is the biggest threat to end commodity price.
Well, I think the major barometer for us is the US equity market, and clearly about 3 or 4 weeks ago this index was really pricing in recession. It was pricing in a world growth number of about 2.5% for next year. I think what's happened over the last 3 weeks is commodities have finally caught up to what the equity markets have been telling us for some time. So I think the assessment has certainly been one where we are now looking at a US and Europe, probably more Europe going into recession, and an environment where these contagion effects are now spilling into China. So there is event risk here has obviously built up, and commodities are catching up actually to what equity markets were telling us 3 or 4 weeks ago.
So talk to me about your favorite picks in this very uncertain environment in terms of commodities.
Well, I think precious metals for us still remains a very bullish environment. I think when I was here a month ago, we did look for a very strong performance in this. It certainly went way beyond what we were thinking in a month. The returns we were seeing, and we hadn't really seen since the 1970s and early 80s, so it had become quite disorderly. But I think we have a commitment of negative real interest rates for quite some time. We still have an idea that central banks are diversifying into this market, and the European banking sector, I think, continues to sustain that tail event risk, which will be positive for precious metals, but particularly gold.
I was going to ask you, is it particularly gold? Because it seems that, if you compare it to other precious metals, gold is just on a different scale, just because it's also considered, of course, more of a haven than silver is and all the others.
Absolutely. I think if you look at gold versus the other metals, whether it's copper, but also silver, platinum and palladium, these what we call reflation or deflation ratios. The ability of silver, platinum, palladium to outperform gold when global growth is under attack is almost impossible. So we would not be recommending the outperformance of other precious metals ahead of gold. Gold has got the qualities that I think this market will be beneficial for gold.
Now, this week, of course, is also LME week. Talk to me a little bit about the industrial metals, aluminium, but also nickel and copper. They're the ones that are, of course, are going to fall the most if we do have a recession or if we have a hard landing in China.
Absolutely. I think what we've seen with industrial metals is their correlation now with the equity markets. The US dollar has increased substantially, and what we've seen over the last month is probably the biggest liquidation in copper of any commodity. This has been picked as probably the most overpriced commodity. It is now, I think, in a sense, building in a price which is consistent with 2.5%. We would say $6,600 on copper is consistent with what equity markets are telling us in terms of world growth. The issue is, have financial markets overreacted? Will we see the ECB cut rates? Will we see China cutting rates? These are the things that we need to see to get some form of stabilization in those numbers. We may well see Europe this week. The problem for China is that it's going to be a lot later, and I think that's what we want to see, is that loosening in credit in China, and that will be somewhat supportive. But we are possibly moving into territory where we've overpriced that recession risk.
But are you more concerned about China? I mean, recession risk there's in China. We had a survey last week which said, I think, that about 42% of respondents think that Chinese growth is going to halve in the next 4 years.
I think we are seeing substantial downgrades to Chinese growth, the potential that the growth numbers move actually below 7%, which is a significant deterioration what we've been seeing from previous years. So I think that is the major problem for industrial metals. This is the country which is 60, 70, 80% of global commodity demand growth for industrial metals, and I think the next few months is going to be a very difficult and traumatic period. It may be that we want to look at food price inflation, and this could be the signal that if this does come down, this can give the green light for the Chinese authorities to move and loosen credit, because actually over the last month they've been tightening credit conditions, which is obviously very negative for the growth outlook.
What about agriculture? I have to say I absolutely adore these little, we have them up on the screen where you can see whether you're bearish or bullish. Agriculture, a little bit more bearish than you are bullish.
I think the concern that we have, there are very tight fundamentals in agriculture, and the difference with agriculture is that it has the ability to production to come on stream very quickly. So I think the rallies are very mature. I think there are structural tightness in these markets, but I'd be watching next year for some of that overpricing within the grain sector to come off, particularly corn. But we've had an unprecedented period for agriculture, 2 years in a row that US corn yields have actually been falling. We haven't seen that since 1974. So there are serious issues here, and we obviously have the La Nina, which is developing and is a slightly unpredictable beast to forecast, but there are sort of event risks there on the South American crop. So we're hopeful that the food price inflation has stopped for the moment and it will start to come down, but I think it's going to be very slow.
What about energy? Because, of course, these are different components. You do have a cartel, OPEC, so being able to get production out, but it doesn't seem like they will, because they need, to sustain their treasuries.
Absolutely. I think the biggest risk for oil is if world growth falls below 3% next year. That is an environment where oil demand collapses, and OPEC have no chance to cut production as fast as world growth is slowing. They have a very poor track record in that environment. They have a great track record when world growth is above that, and they can adjust and manipulate that market. But if it's starting to move towards 3% or below, that's where I think you start to see more downside risk. And the problem for them is that they have spent a huge amount of money in terms of social programs, so the break-even price for them is much higher. So the time at which they come in to defend the price is probably around $85 on Brent. So that's, I think, the critical number. But that is a mix of, I think we only get to 85 if we've got a world growth number below 3% for next year.
All right, very interesting. Michael, thank you so much. Michael Lewis there, thanks again for joining us, Global Head of Commodities Research at Deutsche Bank.